accumulated depreciation is an account which is a contra asset. It reduces the value of a long-term asset. Which would be buildings or equipment. Remember, land never gets depreciated. And so what we would report on that balance sheet at the end of the period is we would have equipment worth $20,000, and we would say less the accumulated depreciation, which at this point has a balance of $600 in it. That difference is what we would call the book value of the equipment, which at this point at the end of October would be $19,400. This is what gets reported on the balance sheet. Okay, let's take a look at the next transaction here. On October 1st, we received $18,000 from a client for accounting services expected to be completed by December 31st. Prepare the journal entry to record the cash receipt on October 1st. When we receive cash, we know that we're going to debit cash. And what's the credit side of this entry? We received it for accounting services, but we received the cash on October 1st. The services are going to be started presumably that day and continued through December 31st. So at the moment we're receiving cash, we haven't actually provided any services. So we're not going to credit revenues, not yet. We're going to credit the account that says we owe services to customers in the future. Unearned revenue or unearned service revenue. So that is the basic transaction. What is the related adjusting entry? Well, time passes from October 1st all the way through October 31st. And at the end of the month, the company has earned 1/3 or $6,000 of those services during the month of October. We need to record the entry for the revenue that has been earned during the month of October. So what do we need to do? We need to record service revenue, and we do that with a credit service revenue for the $6,000. But what is our debit? It's not cash because the company's not receiving more cash. What do? Well, right now, our balance in unearned revenue is sitting at $18,000. But it shouldn't be anymore. We need to reduce it by $6,000 because over the month of October, we've earned and no longer owe $6,000 worth of services. So we can see our ending balance in unearned revenue would be $12,000. So what we need to do is record a debit to reduce unearned service revenue. For $6,000. Once we book this entry here in 8, that will force our ending balance in unearned revenue to be $12,000. And what does that $12,000 represent in unearned revenue? It represents services owed to customers for October's finished, so for November and the month of December. $6,000 of revenues will be recorded in November and then reduced from unearned revenue, and the remaining $6,000 will be recorded in December, and at the end of December there will be a zero balance in unearned revenue. Let's continue on. Transaction 9. The company performed services worth $4,500 that were not billed to clients before October 31st. Prepare the entry to record the revenues for services performed. So it's the actual, it's the action of billing our clients that triggers the accountant to record an entry for accounts receivable and services provided. But if the billing has not yet taken place, we need to update accounts receivable and revenues. So we're going to increase accounts receivable. This is a journal entry that would look exactly like one that would be recorded when the billing does take place. We're doing it before the billing took place because the accounting period is about to finish, and we need to ensure that we don't leave out this $4,500 of services that we've earned and that we expect to receive in cash in the future. So our credit, again, is to service revenue. Now that is the adjusting entry. It's not partnered with a similar one, unlike we had a partner account with the cash we received in advance of providing services and then the eventual services. Remember, we earned the services over time. This one does not have a partner account. It's just the end of the period, and we think about what else has not been included in the balance sheet and the income statement. Here's another one that stands on its own. Well, it's somewhat related to what we saw here. The company had purchased office equipment by signing a note payable. We recorded the note payable, and as time passes, interest has been accruing on that note. It's the end of the accounting period. We need to record the fact that we now owe 1 month's worth of interest. The note requires an annual interest rate of 6% to be paid on December 31st. So if we made the payment at the end of October, we wouldn't need an adjusting entry. We would just need an entry for the payment. It's the fact that we incur this cost as time passes and we're not making payment that we need to remember. Let's record an adjusting entry. All right, so our note is for $20,000 and interest is at 6%. This is an annual rate. We want 1 month's worth. We are accounting for just the month of October. So we need to multiply 20,000 times 6% and then divide that by 12. And our interest expense is 100 for the month of October. We need to record that journal entry so we can see that interest expense on the income statement and the amount of interest owed on the balance sheet. Debit interest expense. And we also need to reflect the fact that we owe interest to the bank, so we credit the liability account interest payable. And transaction 11, employees earn total salaries of $1,000 per day, and they're paid on the 4th Friday of each month. So they're working continually, but they're only paid once a month. At the end of October, 3 days have passed in which employees worked but have not yet been paid. So what are we talking about here? Let's look at 2 weeks of a calendar. Let's say the Friday was here. They got paid here, but then they also worked on Saturday and Sunday and Monday. Let's say it doesn't matter which 3 days. And let's say that this is the end of our accounting period, the end of the day. If we put together our financial statements, the end of the day here, we have not accounted for the fact that our employees have worked for us for 3 days and we have not yet paid them. So we need to book an entry to account for the fact that we owe our employees salaries and wages and that they've worked for our company. So we've incurred a cost, salaries and wages expense. Debit salaries and wages expense, or simply salaries expense. Now 3 days have passed and they're earning a total of $1,000 per day. So the total expense is $3,000. and we owe them, so we are going to record an increase in salaries and wages payable. And now we've accounted for the fact that we incurred the cost and we owe our employees. Our last transaction says that the company estimates bad debt expense for the month to be $1,600. Record the adjusting journal entry for bad debts expense. So why is an entry for bad debts expense necessary? We sold to customers on credit. And remember, accrual accounting says that if we have an expense associated with the sale, record that expense in the same period that we're recognizing those revenues. Well, if some of our credit customers are never going to pay us back, that's an expense, bad debts expense. We need to record bad debts expense for this period. To show that some of our customers that we sold to on credit are never going to pay us back. What account are we going to credit? Now you might be thinking we're going to credit to reduce accounts receivable. And if so, you're on the right track. The only thing is that we don't actually record the entry to accounts receivable. We may have some accounts receivable balance. We see the $4,500 here. Let's just assume that that was the only sale this whole period that we had on credit. So our accounts receivable balance is at $4,500. We want to make sure that we're maintaining a record that we have the right to receive $4,500 from customers, even if we don't receive this whole amount. We want to know which customers owe us how much. So in a separate account, we track our estimate of what won't be collected. We do that in a contra asset account that we're going to credit. Do you remember what that account is called? It's the allowance for doubtful or allowance for uncollectible accounts. Just like accumulated depreciation is a contra asset and it reduces the value of buildings or equipment, allowance for doubtful accounts is also a contra asset. It's our separate tracking account that we use to reduce the value of our accounts receivable. So from accounts receivable, we would say less the allowance for doubtful accounts. Here I'm just going to show it as allowance. And the difference between accounts receivable, the total amount or the gross amount that our customers owe us, and the portion that we've reserved that we think we're never going to collect, or allowance, this difference is referred to as the net realizable value of those accounts receivable. And we have the net realizable value of accounts receivable, $2,900. So we expect that we're actually going to collect $2,900 from our customers, even though they owe us a total of $4,500.